All right, good afternoon, class. You are welcome to Speedy Success Professional. We provide ACA, ACA, and other professional trainings relating to accountancy and business management. Today's topic is financial statement or ratio analysis. I will be looking at introduction to ratio analysis. What are the benefits of ratio analysis? And then we look at users. Tools for financial statement analysis, types and classes of ratio analysis. All right, one more time. My name is Femi Richworld, Aiyeolowo. Please subscribe to our channel. If you have not subscribed, you are just coming you are watching our telecast or our video for the first time, please subscribe. Hit the subscribe button, and we love you. You can also share this lecture freely to your friends who are probably preparing for their professional exams in financial reporting and corporate reporting. Thank you. Let's quickly look at introductions. All right, I have written here that financial analysis or ratio analysis simply the process of building or providing financial information. Process of providing financial information and the interpretation of the same is known as financial ratio analysis. All right, now the information provided is mostly in relation to the entity's profitability, liquidity, growth, and survival. We want to know how much the company profit is per year or in the particular year, and how the cash flows, how liquid the company is, how solvent, how much can they pay at a certain time. The next is the analysis also discuss using the statement of financial position, statement of profit or loss, statement of changes in equity, cash flows, and all the disclosures. Now, when you are preparing statement of the ratio analysis, the major time or major source document are the financial statement, as in IAS 1, IAS 7, and other disclosures as relate to the accounting policies of an entity. The accounting policies of an entity is a great determinant on what you see in the final report of an entity or of a company, whether national or multinational companies. All together. Now let's quickly look at the benefits of preparing ratio analysis and also the limitation. Thank you. All right. Now, when you decide to provide financial information and give interpretation to the users, what you are doing is you are creating what we call analysis or ratio analysis. And what does it do? It helps to determine the profitability of a company at a certain period. We can say a company is 20% profitable, 30% profitable, or 15% profitable, and this allow for decision making by intended investor or the existing investor whether to continue providing capital for such a business or not. Number two, to measure changes in cash flow over time. What to look at how much cash is being spent or available for paying bills in the entity. So we carry out what we call current ratio altogether, or liquidity ratio. Number three, it helps to evaluate management efficiency. We call it management ratio, determining how efficient and effective and economical the management have used the resources given to them in running the business. Number four, ratio analysis helps to determine the financial position of an entity at a given period of time. Is asset very big? Is asset more than liabilities? Is the company running with loan or the company is not running with loan? So we can calculate what we call the gearing ratios. Number 5, it's 5, the last one there, second to last, it helps to compare entity in the same sector and those in another economy or in the economy as a whole. National analysis. Now, the last there is to predict corporate failure or collapse of an entity. When you carry out ratio analysis properly and you interpret it correctly, it can signify whether an entity is going to be a going concern or is going to shut down in the nearest period. So it's very important we understand why we need to calculate or carry out ratio analysis. Take note that the examiner is very concerned about your understanding the reason why we are doing the ratio analysis. So when you are asked to prepare a question or answer a question on ratio analysis, you are not only to just answer, but you are to interpret the result you have gotten. Those of us in case study, you need to master ratio analysis, or else you are joking with yourself. Please prepare very well and follow me on my classroom ratio analysis. Are we together? All right. Let's continue. Let's look at limitations. All right. As much as we can always find out that there are benefits to anything in life, there are also limitations. One of them is that most of the data that are used for ratio analysis are past data or historical data. That is, they are provided from the last period accounting reports. That may not be very useful going forward because situation may change, inflation may arise, there may be other economic factors that will not allow the use of old data in preparing for the future. So one disadvantage is that when you apply ratio analysis of the past, you must consider other factors of the present and the future. Next is the income statement actually does not show the actual value added by employees. So we only see what was done, profit, sales equals to this, and cost equals to that, we have a profit. So it does not demonstrate employees' effort. So management efficiency ratio may not be very valid sometimes when we look at the results. Number 3, it does not cover other qualitative successes of an entity. An entity that is providing environmental value additions, only ratio analysis cannot solve the problem. That's why we have environmental reporting now and a global approach to reporting all the benefits that entities provide while existing in an environment. Number 4, the size of companies might hinder effective comparison between entities. Some entities are bigger, some are smaller in the same industry. So we have problem comparing the entities. Different accounting policies also is a hindrance to effective comparison. Are we together? Thank you. We'll move to the users now. Who are the users of financial statement or ratio analysis? The users are listed here, and what they use the financial statement for varies. The decisions they take from this also varies. We have the management, we have shareholders, we have other investors, suppliers, other creditors like banks, customers, financial analysts like myself, and journalists, public and government. Then we look at the employees. Let me quickly talk about some of the uses. Management use the ratios for most decision making, project decision making, spending decision making, and other decision making. Shareholders use the ratio analysis to determine whether to sell or buy a new share of the same company. Suppliers look at the financial statement to determine how credible, how much can the company pay at the same when goods are supplied to them. Customers want to look at the going concern or the existence of a company for a longer time. Can they provide service for us for a longer period of time? Financial analysts like myself want to use the information in drawing conclusions and to all the users or clients. Public and the government want to take tax, collect taxes from the companies, so they need to know how performing the company are, how much can they pay out of their profits, profit of the company. The public want to know the company that are doing well, so as to relate with them. Employees want to know how much they have contributed. All right, ladies and gentlemen, when we meet in the next class, we'll look at tools and we will look at calculating some ratios. God bless you. Have a nice time. Please subscribe to my video. If you are coming for the first time, if you have not subscribed earlier, please subscribe. You can subscribe once and share to your friends. I love you and God bless you. Thank you.